Good evening or good afternoon, depending on where you're joining us from across the country. My name is Jason Maida. I'm with American Pacific Mortgage, one of your new partners with Texas A&M alumni. Super excited to be with you guys today and get a chance to share with you our home buyer workshop content. I know we're right at the top of the hour. We have a lot of guests that are going to be joining us for today's session, but wanted just to introduce myself and kind of let you know a little bit more about today's workshop and what you should experience. Again, we're a partner with Texas A&M alumni, and we get a chance to bring this content to you and basically talk a little bit about first-time homebuyer home ownership and give you some tools and some resources to help you on that journey towards home ownership. So whether you're thinking about buying, this year as a 2024 goal, or maybe it's something that's in your strategic plan down the road, we want to help be a partner with you and help providing you some education on really what your options look like and kind of what the workflow will be for you in purchasing a home. Now, tonight's class is a very interactive session, so we would encourage you ask questions as we roll through tonight's content. You can use the Q&A function on Zoom, and then I'll do my best to answer those questions on air. I'm sure, a lot of you have very similar questions, so I like to try to share those back with the group as we roll through tonight's content. Now, we're teaching this class nationwide, so I know all of us aren't like in Texas. We're all kind of spread out across the country. Just to help kind of give me a sense of where everyone is joining us from, if you get a second, just put in the chat where you're joining us from across the country, because as we get a chance to dive into some like more market information on what's going on with the housing market, it'd be really interesting to see kind of where you guys are joining us from. So yeah, somebody in San Francisco here in California, so cool. Houston, Texas, DC. Okay, awesome. Great. I love it. Love it. Colorado, College Station, Florida. Okay, great. We're kind of all over the place. I love it. So that's going to be super helpful for me as I get a chance to go into some more of the housing market data. We got a full class for tonight, so really excited that you got a chance to join us. This is our first class that we're doing with Texas A&M for 2024. If you like tonight's content, we would encourage to share this with your coworkers, friends, family. We teach this class specifically for Texas A&M. It's going to be once a quarter, so we'll have 3 more classes available throughout 2024. So if you like kind of what you're hearing, we would love your feedback on maybe what you'd like to see in future classes, but we're going to be bringing this to you again later on this year. So a little bit more about our organization and what we do. Not only are we just super proud about our partnership with Texas A&M, but American Pacific Mortgage, our organization, we're a leader in first-time home buyer programs across the country. So what we do is we help educate the future first-time buyers on what their options look like, and we do that through classes just like this. American Pacific Mortgage is a direct lender, and we're spread out all across the country. We have offices directly in Texas. We have offices in San Francisco, Florida, wherever you're at in the country, we have APM offices to service you. Now, our office is based out of California, but we're in all time zones across the country. So we're here to service you whenever the need arises for home buying. A little bit about me. I'm your presenter, of course, for tonight. I've been in the lending industry for over 20 years. And really my focus is, and I'm passionate about helping our communities in home ownership and creating affordable home ownership. So we first start on this journey by teaching classes like this to help best inform those future first-time buyers on what things could look like for them. Okay, so really excited to be with you tonight. And I want to kind of share with you our talking points for this evening. So we're going to look at the housing market in just a bit. So that's why I asked you to share with me in the chat where you're at. We had somebody jump in from Indianapolis. That's cool too. So we're gonna do some market analysis on what it looks like across the country in the housing market. We'll spend some time also looking at interest rates. We had a lot of movement in today's economic markets. Many of you might have even seen that. So we'll talk a bit about that today. We're going to talk about budgeting. We'll look at credit and how that can impact you from a qualifying perspective as you're preparing for home ownership. I'll spend a brief amount of time talking about student loans. Now, a lot of those student loans are in repayment right now, so you can better understand how that could impact qualifying. We'll talk about loan programs. Spend some time looking at what are some of the documents I should probably start to gather if I want to take this next steps towards home ownership. We'll talk briefly about first-time buyer assistance programs. So whether you're in Indianapolis or Florida or you're out in San Francisco, there are a variety of first-time buyer programs that are out to help service, low, even moderate income households with first-time home ownership. And then we'll wrap up tonight's workshop looking at the workflow of buying a house. So if I kind of raise my hand after tonight's class and I'm thinking, hey, I really want to get on that path towards home ownership, we're going to show you what the next stages or milestones that you'll experience as a future first-time buyer. And then we'll kind of wrap up tonight's class looking at a consultations where we do kind of deep dive in putting together a home buying plan for you. Okay. Again, this is it's kind of an open discussion as we roll through tonight's content. So if you do have questions, use the Q&A function. I'll do my best to answer all those questions on air. And at the end of tonight's class, we'll carve out some time for some devoted Q&A. Okay. All right. So when we think about home ownership, this is probably going to be one of the biggest investments you make in your upcoming financial futures, right? So, the fact that you guys are taking time out of your day on a Tuesday to learn a little bit more home ownership is a big deal. It's going to be the biggest investments we make upcoming. And so in home ownership, there's some really great benefits that come along with it. Now, you have the opportunity to create better affordability or stability, I should say. Hopefully it's affordable for you as well too, because we're not going to worry about our rent going up on a monthly basis. We're going to talk more about that in our budgeting exercise in just a few minutes. But you also create equity in your home. So as your home goes up in value versus what you owe on that house, that difference is called equity. All right. And this is an asset. So as that asset grows over time, you potentially have the opportunity to pass along that asset to heirs of your estate. And believe it or not, there's still some really good tax benefits that come along with owning a home. So when we think about budgeting for home ownership, I think it's really helpful that as we get started to kind of talk more about like, how do we set up our budget for home ownership? And so that's how we always kind of start our classes, is to look at a budgeting exercise. So what I want to do is I want to switch screens here, and we're going to look at a calculator that we're going to actually share back with you tomorrow when we send, actually, we're going to send all of our presentation material to you tomorrow. So because you've signed up for tonight's class, we have your email address. So we'll send out all of tonight's material that I review with you back out to email for you tomorrow. So let's launch into this budgeting exercise. And what we're going to do is we're going to compare renting versus buying and what that could look like for you as a future first-time home buyer. So we kind of just put together a what if scenario here on our screen. And we're going to first take our snapshot of renting, right? So if I'm spending $2,000 a month in rent, and let's say I have an additional expense, renter's insurance of $15, and I make the assumption my rent will probably go up about 5% year over year, right? So every time I renew my lease, my rent's probably going to go up by 5%. Now that could be more or less depending on where you're at in the country, but we'll say it goes up by 5%, right? And then if I'm looking to buy a house, what's my price going to be? So in this exercise, we put 450,000. Now we're going to learn a little bit more about loan programs in just a bit, but the minimum down payment for a conventional 30-year fixed mortgage is 3%. So we have that kind of inserted here. We're going to make an assumption around property taxes. So property taxes can vary by where your home is located in across the country. So taxes may be a little bit more expensive in Texas as opposed to maybe someone purchasing in Indiana. So it all varies, right? But as a baseline, we're gonna put in basically 1.25% of our purchase price. That's what most lenders account for in your property taxes. We have estimated homeowners insurance. We have the maintenance cost of our home. That obviously would vary depending on how old the home is that I'm purchasing and the type of property that I'm looking at. And then we have loan information. Interest rate, or well, first of all, for the term, we're going to put it as a 30-year fixed mortgage. We have kind of as a baseline rate, 6.5%, although that has changed as of today's market. Rates are probably going to be closer to about 6.8 after today's change in market. And then when you select a lender like American Pacific Mortgage, there is origination charges. That's what the lender is charging you for the services. Now, one of the cool things with our partnership in Texas A&M Alumni is that you get discounted services from us. So we actually discount our services by $750 to make home ownership a little bit more affordable for you. And then when you purchase a home, as you select your financing options, you have the opportunity to get a lower interest rate by paying what we call as discount points. Discount points are usually the equivalent of 1% of my total loan amount. So if I want to bring down my rate, let's say by 0.25%. So I know rates are, let's say 6.5 today, hypothetically, but I really need to get to a 6.25% rate because I need to reduce my monthly payment expense. You have the option to pay points to bring down that rate. And like I said, that's like 1% of your overall loan amount, which increases your total out-of-pocket expense. All that being said, in today's market, I'm not a huge fan of paying points because ultimately there's a return on investment time period with points, and it usually takes a couple years, 2-3 years to recoup those funds. And highly likely for those clients that are buying right now, they're probably going to turn around and refinance in the next year or two if interest rates decline. So that investment doesn't always pencil out with points right now. And then other settlement services are going to be things like title and escrow fees, or if you're in an attorney state, you're purchasing a home where an attorney is required. Those are part of the closing costs. Transfer taxes for the county that you're going to buy in. All those things come other settlement services. And then we have other assumptions. So we're going to assume that our home will appreciate about 4.5%, or sorry, let's say 4% on an annualized basis. We think we're going to be in this house for 7 years. Now we can change that calculation depending on what your kind of goal is with home ownership. And then we have the cost of selling my home. So what this calculation is going to do is if I fast forward 7 years, at the end of 7 years, when I decide to sell my home, what's the cost of doing that? So we just kind of projected that at 10%. And then we have state and federal taxes as applicable for whatever state you're in. And then we have a savings rate of roughly 3%. So what the calculation comes back is it says, okay, if I continue to rent for the next 7 years versus deciding to buy over the course of 7 years, my opportunity right now with today's interest rate environment is about $46,000. Now, how did I get there? Well, it takes into consideration my appreciation of my home, which is the biggest factor that's weighing on that, the tax benefits of owning my home. And so when we look at the payment difference, now that's the big thing we're going to have to look at from a budgeting perspective. I know I'm paying about $2,000 in rent, but my house payment's going to be $3,700 a month. So that's a pretty big jump upwards. So as long as I can afford to make that jump, home ownership for this particular scenario would be a good investment, right? And then as I mentioned earlier, potentially if you're able to refinance in the next year or two, now that cash flow improvement, it gets better because now I have a lower interest rate, my payment goes down, and potentially my return on investment looks a lot better with home ownership. Okay. So that's how we kind of like to start our classes, to go into that brief budgeting exercise. And like I said, we'll get you a copy of that same calculator. So I would encourage you, when you have time, take some time out to maybe do that your own budgeting exercise. I think you'd find that a really useful activity for you. So now let's transition to what the housing market is doing. And many of you shared with me where you're joining us from, and that's really a useful kind of exercise for me because I get a better chance to understand, where is our audience coming from? Because the housing market right now is kind of in that seasonal winter lull. If you're in some of the more colder states right now, you might not see as much buyer activity as maybe some of the markets in California. Maybe you're in LA or Orange County or Florida, as opposed to, maybe in a colder state like Indiana right now, you might not see as much buyer activity. But traditionally, we have seasonality in our markets. We have spring and summer buying months, which generally tend to pick up quite a bit. What's interesting in today's housing market is we're seeing a lot of buyer activity. A lot of that stems from what interest rates have been doing since the first of the year, where interest rates have been coming down. Today was not the case, which we'll talk about interest rates in just a second. But seasonally in today's market, not a lot of home activity coming online. So what I mean by that is not a lot of new homes entering the market, primarily because a lot of owners are kind of waiting to see what the market's doing. And certainly as we move to the spring and summer buying months, we should see more more homes enter the market. With buyer activity picking up, the question's going to be, and it kind of goes back to our old economics 101 class, right? So if we have supply at a certain level, buyer demand picks up, what's going to happen is those prices are probably going to push upwards for most homes across the country. So the real question is, how much more inventory can we get on the market? Because we need a lot more in order to satisfy the need for the buyer demand out there. Now, there's a lot of new home builders that are coming into market. That tends to be a popular option for a lot of buyers. But those of us that are trying to buy, the 1960 or 70s home that's a resale home, there's not as many choices out there right now. And so as we look at the housing trends across the country, average or median sales price is just over 400,000 across the country. You can see we have our number of total homes on market. We have a slight little decline here, 7.8%, but I think really that's more seasonality in the markets. The one factor that we don't have here is how long is it taking to sell homes, and we call that days on market. So my guess is we're probably somewhere around 3 to 4 weeks for a home to stay on market before it goes to sell. And so we'll kind of watch that as we move throughout the year. But this is kind of giving you a snapshot of national trends over the last 12 months. Now, what's been kind of changing our housing market is what's going on with interest rates. And so that's an important factor for our first-time buyers that are attending classes and saying, hey, I want to buy at some point. But when we look back at some of our classes we taught last year, a lot of buyers kind of were left staying on the sidelines because this interest rate environment really changed the affordability index for so many buyers. And that's really witnessed by what we see on the screen here, right? This blue line represents the 30-year fixed mortgage. We didn't kind of push far out back into the pandemic days, but in the pandemic days, we saw 2.5% interest rates. And then obviously we've seen a swift incline from that point going forward. Interest rates topped out around 8% back in October. I think it was October 23rd, if I'm not mistaken. Interest rates hit an 8% level. And that obviously really shook the markets. But after that point, we saw rates to start to decline. And then as we've been into 2024 so far, we've seen interest rates kind of bumping around a little bit. The lowest interest rate we've seen is about 6.25%. Interest rates move pretty swiftly today up to about 6.8 today. So if we were to push this chart out to today's market, we probably have rates that are somewhere in that area there. So as we're planning for home buying, interest rates are going to be one of those things that we're going to have to think about. And I think the long-term snapshot of what interest rates look like is interest rates will come down. The question is, where is inflation at? And what drove numbers today up on interest rates is that inflation came in higher than expected. So what's concerning with that is we're waiting for the Federal Reserve to say, hey, we're going to cut interest rates. We thought that was going to happen at the March meeting. Doesn't look like that's going to happen. So the question is not if the Federal Reserve is going to cut interest rates, but it's more so of a when type of situation. So is it going to be in the second quarter, the third quarter, the fourth quarter? We don't know. So today's movement in the markets really was a signal of we really don't know where the markets are going from an interest rate perspective. So I know a lot of buyers are holding out to find out when interest rates are going to hit that lower level, but it still is more of a kind of a to be determined type of situation. Now, with interest rates, they're not all the same for all clients because they vary based upon a few different characteristics. One is your credit eligibility. So the higher my credit score is, the lower my interest rate could be. The type of product that I'm going to select could influence my interest rate. How much I decide to finance could also change my interest rate. Down payment. If I'm putting 3% down versus say 20% down, that could change my interest rate offering. We talked a little bit about discount points earlier in today's discussion. That's the opportunity for us to pay additional costs to bring down my interest rate. But again, doesn't always make sense in today's market. And then finally, the term of my loan can change my interest rate offering. So traditionally, as a first-time buyer, we're going to utilize a 30-year fixed mortgage product. That means my interest rate is fixed and my payment is fixed for 30 years. But if I want to elect maybe a 15-year fixed mortgage, traditionally, that would actually lower my interest rate that I can take on my mortgage. But the trade-off is that monthly payment is going to be much higher because I'm squeezing that term from 30 years down to 15 years. As we meet with our clients that go through consultations, we're going to figure out the right product match for you. And so, that's something we'll help kind of spearhead and just make sure that, we give you all the tools and resources you have to make a good decision in your financial plans for homeownership. So you saw on the last screen that credit plays a role in interest rates. And as we meet with you to go through credit, it's really helpful to understand kind of where you're at from a credit perspective and if there's any areas of opportunity to help lift your credit score. Now, I know many of you attending tonight's class like have different tools that you rely on to manage your credit. You know, you're probably getting alerts from your Experian app or Credit Karma or Equifax or TransUnion, and that's all great. But I think it's important to understand kind of the weighting, if you will, of the credit system, especially when it comes to the mortgage scoring. So if we look at this screen here, this shows you the FICO score calculation and how the weighting works. 15% is going to be how long I've had credit. So the more mature my credit file is, the better my credit score should be. 20% is going to be how much new credit am I trying to put into use? That is new accounts that are open, but it's also hard inquiries. So a hard inquiry means I'm trying to apply for credit. The more inquiries I do, the bigger impact or negative I'm going to have to my credit score. Now, in working with our team to start your home buying plan, we actually start with a soft credit score, which doesn't impact your score at all. So it just gives us visibility to your score. The reason why we like to do that is because we don't know how long it's going to take for you to find a home, right? I have some clients that have been shopping for 2 or 3 years or maybe 2 or 3 months, but at the end of the day, whatever that timeline looks like for you, we want to make sure that we don't put an impact to your score. So 20% is going to be the new in-use hard inquiries and new accounts. 30% is going to be around revolving debt. That's called credit utilization. The higher my utilization is, the lower my score is going to be because I have a bigger impact, right? The optimal level to have credit utilization at is below 10% utilization. Now, the way credit utilization works is I'm going to take in aggregate my credit limits versus my credit balances. So let's just make the math simple. So if I have a $10,000 in credit limit, my balance is $5,000. That means I'm at 50% utilization. Now, ideally, we want to get that below $1,000, right? So I know we're still coming out of the holidays. Our balances are maybe a little bit higher than we would like. So our first goal, if we're like at 80 or 90% utilization, so that means I'm at $8,000, $9,000 credit balances, bring that below 50% utilization. That'll give us a little bit of a pickup in our credit score, and then work towards the 10% utilization. Okay. Now, let me give you a quick tip on how to best manage utilization to help optimize credit scores. So as kind of a homework assignment tonight, if you will, when you get a free moment, pull up one of your credit card statements. There's going to be 2 important dates there. There's your billing cycle date. There's your due date for your payment when it's due, right? Well, the billing cycle date represents the date at which the credit card issuer is going to send out all of your payment information to the 3 major credit agencies. And we know those are TransUnion, Equifax, and Experian. So if you're in the habit of paying your bill on the due date, which is nothing wrong with that, what you're seeing on your credit bureau is kind of an artificially higher balance, because what happens is that data is sent to the agencies at the end of the billing cycle date. So my tip for our class tonight would be is if you can try to pay off or pay down that credit card before the end of the billing cycle date, then you're going to get a much improved credit score. And so when you go to apply for a mortgage or anything else, you should have a much higher credit score because that lower utilization is now reporting to your bureau. Then the last weighting or component for the credit score is payment history. So we all know that's kind of self-explanatory. I'm looking at how have I paid my bills. If I've had some past challenges, those are going to be rated as 30-day lates, 60-day lates, and 90-day lates. Now, the more severe my late is, the bigger impact I'm going to have to my score. And from the date of last payment or date of last late payment, it'll be within 12 to 24 months that's going to have the biggest impact to your credit score. So if I had a late in my student loan from maybe September of last year because my loan just came out of forbearance and I forgot to make the payment, well, that's going to hit me a little bit harder than maybe a late payment that I had 3 years ago, right? Okay, any questions on the FICO score calculation? I know I've given you a lot so far. I want to keep us on time for tonight's class, but any questions so far? And if you do, drop those questions in the Q&A and I'll get those answered for you on air. Okay, all right, looks like we're good so far. Now, every loan program has a minimum credit score requirement. You can see them on screen. So we're going to talk about a few of those in just a minute. So your FHA loan, minimum credit score of 580, conventional loan 620. Some of our government products like the veterans loan to help support our veterans, minimum credit score of 620. And some of our clients that want some support in financing that are choosing to maybe purchase in rural areas, minimum credit score of 620. Now, major events like bankruptcies or foreclosures, those are going to have a larger impact to our credit score, especially within that 12 to 24-month period. Every loan program will have seasoning periods for big events like that. And we'll talk more about that in just a minute during our program session. We talked a little bit about utilization. We didn't talk about account closure. And what we're talking about with a closing of account is that if I decide to terminate my relationship with a credit card issuer, what that does is it takes, and let's say, for example, I have a card that I've had for 10 years, but I close out that account. Once I close out that account, that pulls away all that really great history from my credit bureaus. It also lowers the available credit that I have on my total credit bureau. So there's two big impacts that could happen there. You could hurt your length of credit, but also hurt the utilization component of the credit score. So you really want to be careful before you close out accounts that it doesn't deteriorate your credit score. In lending, there's three, we look at all three scores through all three agencies, but we always take the middle score. And so what I mean by that is that if I had a high score of 760, my middle score is 740, and let's say my lowest score is 720, the middle score of 740 is what we use for qualifying purposes. Now, let's say I'm going to apply with my partner, but my partner score is 700, 680, and 660. The 680 is technically the lowest middle score between the two of us. So the 680 score would be what would be used for qualifying purposes. And that's really important because they could change my interest rate offering, could change my loan program offering, even my mortgage insurance for my loan financing. So we'll walk you through that during a consultation, but I think it's important to understand that as a future first-time buyer. Now, with credit, there's different time periods on how long events that have been maybe past challenges will stay on your credit report. So this matrix kind of helps you better understand that. Hard inquiries will be on your report for 2 years. But if you've had like a federal, like public records, bankruptcies, tax liens, those can be on for 10 years or less. The most recent 12 to 24 months is really where you're going to have the biggest impact. Okay, question came in the chat, which I think we talked about earlier, but we'll cover it again later on too, but I'll answer it now, which is what are the incentives that we provide? And the question was, how many points do we charge with a loan? So our incentive for our Texas A&M alum is we have a $750 discount in our services. Our loans are no points loans unless that's something that you choose to do. So it's not an automatic where if you decide to do financing as points, that's your option as a buyer if that makes sense for you in your plan. And then another question in the chat came, do credit inquiries do credit inquiries happen when you sign for a lease at a new apartment also negatively affect you? They could, because depending on what bureau they're accessing, how many times they need to do it, when you're trying to, set up a new lease for apartment, that would technically be a hard inquiry. Okay. All right. Great questions. I appreciate the interaction there. Let's talk about student loans. And student loans are going to impact some of our clients as they're building their home buying plans. As those loans now have come into repayment status for many of us, I think it's helpful to understand how we calculate that from a lender's perspective. So if you're in an income-based repayment program, then there's a calculation that we use for both a conventional loan and an FHA loan. So for a conventional loan, we can use the income-based repayment amount that you've signed up for with your servicer. So if you've got, let's say, $75,000 worth of student loan debt and your minimum payment is $250, well, that's the payment we're going to use from a qualifying perspective. And that would hold true for an FHA or a conventional loan. Now, if I don't have a repayment program set up and, maybe I'm thinking about, maybe I'm back in school, right? Or I'm still in forbearance, then we still have to count a minimum payment for qualifying purposes. By default, on an FHA loan, we count 0.5% of the outstanding balance for your monthly payment. For a conventional loan, it's 1% of the outstanding balance. So, and that obviously can change the qualifying. So instead of that $250 IBR payment or income-based repayment, now it's maybe $375 for an FHA loan or $750 for a conventional loan. Now, as a reminder, if you're in forbearance or you're back in school, I do realize that those loans are not in repayment, but in order to determine qualifying, we still have to count that minimum payment to figure out what your eligibility looks like. Okay. One other kind of side note on student loans, if you're in a forgiveness program, for some of our clients that are in public service, they usually have a 10-year forgiveness plan. That's great, but we still have to count the minimum payment. And then once those loans get forgiven, then of course those aren't factored into the calculation. Okay, it looks like we have a hand raised. So if you had a question, go ahead and drop that in the Q&A. I think that's Caleb with the hand raised. Just go ahead and throw that in the Q&A, and I'll get that question answered for you. Let's talk about loan programs. And during our class, we'd like to share with you kind of 5 of the main programs that are offered, and they have a variety of different features and benefits, right? So let's kind of dive into each one of those. We're going to first look at the conventional loan product. And the conventional loan, when we think about a conventional loan, that's for Fannie Mae and Freddie Mac loans. It's a nationwide product. It's somewhat government sponsored, but it's going to be under the Fannie Mae and Freddie Mac guidelines. The maximum loan amount is $766,550 for most parts of the country. Now, if you're in a high cost of living area, so one of our classmates here tonight is in San Francisco, right? So that particular future buyer has the opportunity to go up to a much higher loan amount. So in San Francisco, it's like 1.149 because it's a higher cost of living area, okay? Now, up to the maximum loan amount that you see on screen, the minimum down payment is 3% for a conventional loan. If we go beyond the maximum loan amount and we're buying in a high cost of living area, then that minimum down payment goes to 5%. Now, the minimum credit score on a conventional loan is 620, and conventional loans would be probably more the most favorable option for most of our first-time buyers that have that eligibility. There's some benefits around mortgage insurance that makes it a little bit more affordable, and it has the lowest down payment option at 3%. Now, we're going to do a comparison in just a minute between conventional loans and FHA loans, but let's dive into the FHA product specifically. So FHA is going to be a government-insured product, has a minimum credit score of 580. That also goes up to that same loan amount of $766,550. Same policy holds true that if I'm in a high cost of living area, I can go up to higher loan amounts. However, the down payment remains fixed at 3.5%. Even in the high cost of living areas. Now, FHA has some different requirements that are a little bit more lenient as compared to the conventional product. And the mortgage insurance component with FHA looks a lot different than it does for conventional loans. And we'll talk about that in just a minute or so. Now, for our veterans that have served and have VA eligibility, the VA product is an amazing tool for veterans. It's a 0 down payment option. You can go $1 million plus in loan amount. The guidelines are much more lenient to help best support our veterans with home ownership. So if a veteran has had some maybe past credit challenges, it'll add a little bit more flexibility there. Higher, we call debt to income ratio requirements. Minimum credit score for the veterans product is 620. And then we have our USDA product. So as I mentioned earlier, for clients that choose to purchase in maybe a rural area that qualifies under USDA, there's 0 down payment options. The USDA has 2 kind of big qualifiers. It's based upon your household size and income, and then the location of the property as defined by USDA. So if you meet those 2 qualifiers, USDA can be a fantastic tool. Does not necessarily have to be a first-time buyer situation. And then for clients that need to finance a little bit more money, they have to go beyond the maximum loan amounts. There's what we call as jumbo loan programs. Those aren't like the typical program for our first-time buyers. And there's a few reasons why. One is because most of us are going to have to purchase at a much higher purchase price. But more importantly, the down payment minimums are so much higher. The minimum down payment on a jumbo loan is 10 to 15%. FICO score requirements are a little bit higher, 680 plus credit scores. But there's also additional asset requirements on a jumbo loan. What you'll have to save up for is not just only your down payment and your closing costs, it'll also be what we call as reserves. Reserves are going to be additional assets that I have left behind after I've contributed my down payment and my closing costs. Usually the reserve requirement is the equivalent of 12 months of my monthly payment. So if I have a $7,000 mortgage payment, I need an additional $84,000 in assets after I've contributed my down payment and closing costs. Okay. Now, we haven't talked too much about closing costs, but we will a little bit later on in tonight's class. Closing costs, as we went through our budgeting exercise earlier, those are the costs for some of the like local municipality charges, title and escrow fees, attorney fees. When we think about our budgeting for that amount of money, usually the closing costs are going to be estimated at somewhere between 2 to 3% of our overall sales price. Okay, so we had a question that popped in the Q&A, so I want to just check that out real quick. So question was, what resource can we best be used to determine if you qualify for a VA loan? Can a mortgage lender determine VA loan qualifications, or does that come from a third party? So a mortgage lender that's VA approved determines you're qualifying for a VA product. If you have eligibility, there's a document called a certificate of eligibility, or COE, that we would obtain from the VA. It's all accessible online. We'll just need some information from you to see, if you in fact are eligible. So, kind of offline, if you'd like us to assist you with that, just let us know. We're more than happy to jump in and give you some additional support there. Okay. All right. Let's talk a little bit about PMI. So you may have heard about PMI and don't quite understand it. So we want to kind of explain PMI and how that impacts you from a buying perspective. What does PMI stand for? Well, it stands for private mortgage insurance. And it's insurance that basically protects the lender against the buyer default, but the buyer is responsible for paying that. Now, there's different ways in which PMI is structured, both for a conventional loan and for an FHA loan. And specific to a conventional loan, there's different payment options that you can take on MI. So there's monthly MI. You can take that MI, you can split it, some of it up monthly. You can pay some of it up front. So that's called split MI. There's also what we call single premium MI, where you're basically buying out the mortgage insurance for the life of the loan. And there's also lender paid mortgage insurance. And that's where we're taking and elevating the cost of our interest rate to take the difference in that interest rate. So let me just explain this. So let's say market interest rates are 6.5%, but I want to buy out my mortgage insurance. I could elect like a 7.5% interest rate and use that proceeds, basically, if you will, of the interest rate for the lender to buy out mortgage insurance. Not a super common option, especially in today's market. The biggest and most popular option is the monthly mortgage insurance. And the reason why that is because, as you can see here, mortgage insurance has a cancellation option that when I reach 2 years in my home and I have at least a 20 to 22% equity position, I can apply to have my mortgage insurance canceled. Now, if you've started your home search on Zillow or Redfin already, there's payment calculators there. However, we would caution you in using those. The reason why is because a lot of those PMI calculations are not adjusted to meet these criteria. So PMI is different criteria to it. We look at credit score, we look at down payment, we look at how much we're financing. All of those factors will lead up to a PMI premium. It's almost thinking about like auto insurance, right? So the better my auto or my driving record is, the less expensive my car is. My auto insurance should be a little bit less expensive. PMI is the same thing. Better credit score, higher down payment, lesser my cost is going to be for my PMI. So if we looked at a scenario down here at the bottom and we took let's say a loan amount of $450,000, we're putting down 3%, our FICO score is 740 plus, we're probably looking at PMI of about $183 a month. Now, if we put that same calculation in Redfin or Zillow, we're probably looking at $350 or $400 a month. So just something you want to be mindful of as you're going through calculations for your home ownership. Now, we'll talk about one of our resources later on. It's our mobile app that you can do calculations right there, mobile, and it's all calibrated correctly. So we'd encourage you to kind of check that out as one of our follow-up resources. Now, FHA mortgage insurance is a little bit different. FHA mortgage insurance has two forms of mortgage insurance. There's monthly mortgage insurance, which is 0.55% of my loan amount. There's also upfront mortgage insurance, which is 1.75% of my loan amount. So I have to add that on top of my total amount financed. Now, with FHA mortgage insurance, there is no cancellation option. So the only way to exit mortgage insurance is if I was to refinance out of the FHA loan into, say, maybe a conventional product. Now, if we take FHA and look at the calculation here, we take the same $450,000 loan amount. Our PMI is roughly about $206 a month. But then there's also this upfront mortgage insurance of $78.75 that gets added into the total amount financed. So now I'm going to finance a little bit more money with the FHA product. So taking a kind of a step back for a second, if you're looking at your different options as a first-time buyer, you may at first glance say, wow, I would never choose FHA because, Jason's saying it's a little bit more expensive. So I don't really want to go down that route. And that you might be right in that scenario, but not all of our clients qualify for a conventional loan. So it's really important for us to provide you with different options. FHA is going to be a lot more lenient from a credit perspective. If I've had some past challenges on my credit, a lot more leniency there. Where conventional loans, really will be looking at that last 12 to 24 months, making sure that everything is in really good standing, a little bit higher FICO score requirements. So there is differences between the two products, but certainly as we meet with our future first-time buyers to design a home buying plan, we're going to figure out what's the right match for you based upon your home ownership goals. Now, as we're rolling through tonight's class, I always like to kind of share with you around the section around income, because we get a lot of questions around what qualifying income looks like for some of our buyers, but also some of maybe the documents that I'm going to need to gather as I'm starting the process of home ownership. So let's first of all talk about some different scenarios around income that I think might be helpful for you, because there is a lot of misconceptions out there in the market. And the first one is around the 2-year employment requirement. So a lot of people think to go out and buy a home today, I need at least 2 years on my job, which is not the case. The way the rule is written is that you have to have 2 years between your job and your education. And as long as you fulfill that, you could potentially be eligible. Now, where that 2-year requirement gets a little different is that if you're like, let's say you're in the healthcare industry and you have 2 facilities that you're working at for different employers, right? In that scenario, I would have to show that I've been working at both locations for 2 years simultaneously in order to count both sources of income. So that's kind of where that 2-year rule applies. But certainly in terms of my education and my employment history, I just have to put together a full 2 years from that perspective. Now, if I'm, let's say, working a 40-hour work week job and I'm also driving for Uber on the side on the weekends and I want to count that income, as long as I can show that I've been working for Uber for 2 years and working on my full-time job for 2 years, then both sources of income can be counted. If I'm an independent contractor, I get 1099. I do have to show in that instance that I am working I've had my employment for 2 years, or I've had my business for 2 years in essence. Now, occasionally, as we're working with clients, they may have supplemental income from a partner, but that partner chooses not to be on the loan application for whatever reason, right? I can't include that other income into the qualifying unless that person is going to be part of the loan application. So that's just something to keep in mind as you're pursuing home ownership. At times, rental income can be used. So if you're in the habit of renting out a room at your place right now, and you want to do the same thing for the next place that you buy, that could be potentially used as supplemental income. But for most first-time buyer programs, it's not going to be allowed. Okay, so we had a question in the Q&A, so let's just bring this to the group. The question is, I've been working for the same company for 5 years. So if I were to switch jobs here in the next month and then applied for a house, will that hurt me? I was told I had to wait 2 years with the same company. So that kind of just right there, that's kind of a case in point on misconception. So the way the rule is written, so if you decide to get a new job, as long as we have an accepted offer for that new job, then we can use that income right away for qualifying purposes. So the answer is no, you don't have to wait that full 2 years on that new job. All right, great question. So this is some of the documents on screen that we would typically need to start the process. So if I say, hey, I want to help design a home buying plan with you, Jason, and I want to know a little bit more, these are some of the documents you typically would have to gather in the process. So last 2 years of taxes, W-2s, you probably got your 23 W-2 already, bank statements, and generally the last 60 days of pay stubs. If you are self-employed, we'll definitely need the last 2 years of taxes, and we'll kind of walk through any other documents that you might need, depending on maybe how your taxes are structured. Staying with the theme of income, I want to share with you qualifying income when it comes to looking at a calculation that lenders will use to determine eligibility for most loan products. It's called debt to income ratio. It's a really simple calculation. It takes into consideration your pre-tax income versus your monthly obligations. So we're going to walk through a calculation in just a second, but this calculation takes into consideration the obligations that generally appear on your credit report, like a student loan or a car payment, things like that. Now, if you have daycare expense or you're, contributing to an investment account or you're doing whatever, that's not factored into the debt to income ratio. This is simply looking at more of your credit related items. So we're taking your pre-tax income versus those obligations. So if I looked at this calculation and I now want to factor in my housing expense, so we take into consideration like the principal and interest, the taxes and the insurance for my new house, right? We have PMI if I've put less than 20% down to buy my house, HOAs if I'm buying maybe a condo or townhouse. Some of the single family homes may have HOA expenses, so keep that in mind. So in this scenario, I have like $2,400 a month in expenses. If my other debts are $500 a month and I'm making $8,500 a month, then my debt to income ratio, so expenses versus income, is about 35.29%. Most lenders can go up to 45%. At times, we can go as high as 50%. Don't really recommend that unless maybe there's some other income that maybe we unable to document. The question I get often from our classmates or folks that are attending our classes is, what should the debt to income ratio really be, Jason? There's not really a right number, but generally we see that comfort level being around 33 to 36% debt to income ratio. We have two real big goals with homeownership for our future first-time buyers. One is we got to build an affordable plan for you. So debt to income ratio is only a qualifying metric. Affordability is the most important thing, right? And then we want to make sure it's sustainable for you. So, 10 years from now, we want to say, hey, wow, I love my house. I've had all this appreciation. Now I'm ready to sell. I'm ready to maybe buy my next home, right? So that's why those two big goals are super important for you, hopefully with home ownership. So the last component to building a plan, and one of the last topics in our class tonight, is going to be down payment. And we just actually released a video on savings plans for down payment, because it's probably one of the hardest things for future first-time homebuyers with the cost of living today, right? It's just not as easy to save for your down payment. So these are the typical documents that we'll need to basically document or validate your assets you use for a home purchase. But there's other things that you can use, like gift funds where family members are helping out to support you with down payment resources. You can potentially use your 401ks or 403bs, but we would encourage you to talk to a tax or a financial advisor before doing that. If savings for your down payment is a little challenging, one of the kind of the tips that I would share with you is that as you're thinking about home ownership, if you're, let's say, paying $2,500 a month in rent right now, but you think if you were to purchase a home, you could spend maybe $4,500 a month, don't wait. Try to get yourself on the path of savings now. And here's what I mean by that is, try to develop a discipline on a monthly basis to basically save like you're paying a $4,500 mortgage payment today. So that would basically mean I have $2,500 in rent, $4,500 in home payment. So I have a $2,000 variance right now. So if I was able to take $2,000, put it in my savings account every month, before I know it, 6 months, I have $12,000. Before the end of the year, I have $24,000 saved. The amount starts to stack up, especially in today's savings rates where, some banks are offering 4 and 5% interest rates. Really encourage you to work on the savings plan. I know it's easier said than done, but hopefully that can give you a kind of a resource to, kind of help you on that path towards savings. It doesn't have to be $2,000, could be $200, right? But at least starts that savings for you. Now, all across the country, there are a variety of first-time buyer programs that are available to you. We're going to showcase just a few here. So for those of our guests that are joining us from Texas, there are some really cool first-time buyer programs in Texas. Freddie Mac offers incentives for low-income housing buyers across the country. Because we have an audience that's spread out all across the country, we'd encourage you to get connected with us. We'll share with you the different first-time buyer programs that are available to you and share with you what resources could be a good match. But Freddie Mac offers the Borrow Smart program, allows you to get an additional grant of $500 to $1,500. It also offers lower rate options for some of our low-income housing buyers, as well as lower mortgage insurance scenarios too. So that'll help make homeownership a lot more attainable, a lot more affordable. And then in the state of Texas, there's the My First Home program. And what the program does in the state of Texas is it provides up to 5% of your sales price in assistance. You can in turn take that 5% to apply it towards your down payment and closing costs and reduce your overall out-of-pocket expense. And you can either pay back that grant pay back that loan, or you can take those funds as a 3-year forgivable grant that'll have other restrictions for that. So if you're in Texas, like I know quite a few of us are, if you want to get connected and talk about some of those first-time buyer programs specifically for the state of Texas, we'd love to be able to do that for you. But we'll also kind of guide you through any other programs that are available to you. I know we have guests in Indiana or Florida or California. We can certainly share with you some of the resources that are available to you there too. All right, I'm going to take a quick pause before I go into the 6 steps of home buying. Any questions so far from the group that I can help answer? All right, we'll keep it moving. We're going to now talk about the 6 steps of home buying. And so these are the different milestones that we're going to go through in our journey towards home ownership. So after tonight's class, you want to get connected with us, we would love to do a consultation with you. That's a free service we provide to help develop a home buying plan for you. Now, the output of that plan is to get you pre-approved. Now, you don't have to be ready to go buy a home this weekend, right? Pre-approvals are designed to have you get together like a roadmap for home ownership. And the pre-approval, when you're ready to go out and start looking at homes, if you decide to make an offer, the pre-approval will be basically a certificate that your realtor will provide to the seller that says, hey, I'm eligible for my financing, that I can afford this home. So when you do make an offer, they know that the financing is all ready to go for you. Generally speaking, the pre-approval is good for 60 days, but it can always be recertified at any time. So if you're looking to buy this year or next year, it doesn't hurt to get pre-approved because we can always recertify everything. And we only start with a soft credit check, so you don't have to worry about any impact to your score. Second milestone is the home search. And that generally starts online, as we've kind of talked about earlier tonight. Once you decide you have a few homes queued up that you think you really like and you want to go check them out, we would really encourage you to work with a realtor to go out and look at those homes. You can certainly pop into open houses or go to a new home development, but working with a realtor, that realtor should be an expert in their market. They're certainly going to help you with negotiations of your home price, inspections for your home, hopefully help guide you through the right purchase for you, while of course we're handling the financing side. So let's say you make an offer to a seller, right? The seller says, you know what, we will accept your offer. And, and by the way, it doesn't probably happen on the first go around. So it probably will take 2 or 3 offers before you get an acceptance. But let's say in this scenario, we get an accepted offer. Well, that's going to move us to step 3. It's called entering escrow for most states. That means the seller has accepted our offer. When we get notification as our team goes that you get an accepted offer, I'm going to give you a call directly and say, hey, congratulations. Here's what to expect next. And we're going to schedule you for what we call as a follow-up video consultation to review all the details of your financing. Now, your responsibility as a buyer at that milestone is to provide your earnest money deposit, which is usually the equivalent of 1 to 2% of your purchase price. Those funds will count towards your total out-of-pocket expense, but it's kind of your good faith investment into the purchase. At step 3, now the process starts to begin, because now we're in what we call as escrow for most states. And that escrow time period is usually 30 days. Sometimes it can be shrunk down to as little as 14 days, but from the time your offer gets accepted to the time you get your keys to the house, it takes about 30 days. Here's what an earnest money deposit looks like. It's, like I said, 1 to 2% of the sales price. It could look different in terms of the percentage of investment, depending on where you're at in the state. If you're in California in the San Francisco Bay Area market, they may want to see 3%, whereas maybe you're in Texas, it might be 1%, right? So every market will look a little bit different, and we can kind of talk through that with you during a consultation. Now, most states have a provision of contingencies in their real estate contract, which allows you as a buyer to do your homework on the property and have that deposit protected. There's a couple areas around contingencies: appraisal to make sure the house is worth what you're buying it for. Here's an example of that. In fact, we had this example just today with one of our clients, that the client's buying a house for $375,000, the home appraised for $370,000, which is less than what they're buying it for. So that buyer has an option to either pay the difference or to renegotiate the purchase price or completely cancel the transaction. They were, in this particular example, they were able to renegotiate the price down to $370,000. And that's why that appraisal contingency is super important. And then the inspection contingency allows you to go out and do your due diligence on the condition of the property. The loan contingency is for your loan approval. So as your process starts for your loan, our team will be doing some of the underwriting and the processing of your loan, which takes a couple days in the overall kind of escrow time period. By the time we get to step 4, your rate is probably locked in on your product. Especially in today's like today where the interest rates went up pretty massively. Like we want to make sure our clients are locked in to provide them that protection of the interest rate going up. Step 5 is going to be your loan approval. That also takes us about 3/4 of the way through the process. So by that time we have loan approval, we're going to near the end of a contingency period too. So we should have the appraisal back and hopefully it satisfies the expected value. You have your loan approved and then you have your inspections done. So as long as you're in a state that has contingency provisions, if you feel comfortable moving forward, then you'll sign off on your contingencies. That takes you to the very final milestone, which we'll talk about in just a second. We're also at step 3 going to give you a final closing disclosure that gives you a 3-day cooling off period before you actually get to that closing of the loan phase at step 6. Now, throughout the entire process, as a lender, we provide to you e-signature disclosures. So everything is disclosed to you, every change that's made on your financing, because you need to make sure that you're super informed throughout this process. At step 6, though, everything is now done in person in a transaction. That's throughout the entire country. So everything has to be done in front of an attorney or a notary for home financing. And step 6 is when you sign those final documents. You also provide any final funds that are owed for your home transaction. Those funds will get taken in by the escrow team or the attorney's office, depending on where you're buying. And at that point, as a lender, we're now going to wire in the funds for your home financing. And if you've elected any like assistance programs, we'll be wiring those funds in as well too. Those funds get reconciled and balanced by the escrow party team. And once that's all compiled, documents get recorded with the local county recorder's office, wherever you're purchasing. They record usually 2 deeds to the house. There's a grant deed to transfer ownership from the sellers to you, and the deed of trust, which is your agreement to repay the loan. And once we get confirmation of those deeds recording, that's when you become the official owner of the home. That's like my best part of my day because I get a chance to call all of our home buyers that are now new home buyers to let them know now they're going to get the keys to their home later on that day. So I got a chance to make those calls today. Love it. Again, best part of my day, but it's a huge celebration, right? Because as we launched into tonight's class, this is going to be one of the biggest purchases you make in your upcoming financial future. So again, kudos to all of you for kind of hanging in there and checking out tonight's class to learn more about how to go through that process. Now, if you're thinking about moving forward, you want to get together with us for one of our free consultations, we'd encourage you to take some of the steps noted in this slide here. You do a kind of a no obligation application. We only do a soft credit check, and then you upload proof of your income and assets. And then you schedule a video session with us, and you get a chance to meet with me one-on-one for those sessions. Those are about 30-minute sessions that just helps us develop a plan. And so whenever that time comes that you want to pursue homeownership, you know what that roadmap looks like. Now, some of us may have some like specific questions for our finances coming out of tonight's classes that maybe we don't want to ask in the classroom setting. Feel free to get connected with us for an introductory call. Our team will be here to help answering those questions for you. This is what our consultation looks like for you. So again, it's about a 30-minute session for you looking at your budget, credit, where do I want to buy, applicable assistance programs. And then if we decide to move forward, then you have that pre-approval to start that home search. Okay. Now I mentioned to you earlier, we have some really great resources. One of those is our mobile app. So whether you want to start the process tonight or you just want to, learn a little bit more about like what a payment calculation looks like, you can do it all through mobile. That can be found here through our links available for both Apple and Android. And as we're wrapping up tonight's class, again, we're super proud of our community partnership with Texas A&M alumni. The team at Texas A&M has been fantastically supportive of us. And we're really excited to bring 3 more classes this year for 2024. This is a 3-year agreement we have with the alumni. So we plan on really investing in our partnership in our communities to help really create affordable and sustainable homeownership across the country. We also have other alumni across the country that we support too. So if you, like I said, if you have friends or family or coworkers that either are affiliated with some of these partnerships or just want to learn a little bit more about homeownership, we'd encourage them to kind of check out some of our upcoming classes. Those can be all found at Texas A&M Mortgage, texasammortgage.com, or you can visit us at mortgageeducate.com. And we love what our clients across the country say about us. So we'd encourage you to check out some of our Google reviews. We also have helpful content on our socials. So on Instagram at JMaida Mortgage, we're posting a lot of informative stuff for first-time buyers, whether it's a savings plan, tips on credit, or the latest first-time buyer program. So check us out on Instagram for some of those resources too. So we're almost at the top of the hour. I know all of you have stayed along with us for tonight's class. I want to open it up for some questions before we wrap tonight and make sure we got everything answered for you. So feel free to drop any questions in the Q&A before we end tonight's class. And again, I really appreciate everyone taking time out of your busy Tuesday night schedules to join us. We've had a really wonderful audience tonight, and we're really proud to be able to help support you with this content. All right. Any questions in the chat or in the Q&A? Okay. Okay, I think we got most of them. Let me just make sure. Okay, I think we're good. Any other oh, we got one in the chat. Okay. So question was, what's the best way to get connected with us for like a personal question? So if you do an introductory call, so let me just kind of switch back here. So there's the introductory phone call. You can just book a session with us. That's just like a 15-minute call. And we can make that happen for you. That's really easy to do. We're going to send out this presentation tomorrow morning to you. So you'll have all the material and all the helpful links so you can do all your budgeting that you guys want to. And another question was, do I need to be at my job for 2 years consecutively to qualify my income? So the answer is no. So we talked about that a little bit earlier. So the 2-year requirement is around education and employment. So you could be on the job 1 month and still potentially qualify for your home mortgage. All right, great questions, everyone. And I'll just kind of go back to the last slide. We had so you can see all my contact information. So feel free if, drop me a message there. You can also, like I said, schedule an appointment. Another question came up was, does the amount of mortgage affect the interest rate at all? For example, would a $150,000 loan have a different interest rate than a $400K loan? It could potentially. That'll depend on amount of down payment, credit score, but amount of down payment can, as we talked about earlier, influence the interest rate. If you like, offline, we can talk about some different scenarios and how that affects the prevailing interest rate. All right, thanks for the question. Okay, many of you are still hanging in there with us, so thank you so much for that. Any other questions from the group? Okay, I think we're good. Okay, we only kept you 2 minutes over in class, so thank you so much for joining us. Again, you have any questions, feel free to get connected with us. We'd love to be able to get partnered with you to be able to help you on your path towards homeownership, and we look forward to connecting with you all in the future. Have a good night.